Listening to Radio Cayman, the voice of the Cayman Islands.
Money Sense is brought to you by the Chamber Pension Plan. For further information, visit chamberpension.ky. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you. We are a not-for-profit, member-centric plan with a democratically elected volunteer board of trustees representing all sectors of the Cayman Islands economy. We have an all-in expense ratio of less than 1%, over 20,000 members, and $490 million in assets under management. We were the first multi-employer pension plan approved by the regulator in the late 1990s, and today we are still strong, secure, and are here for our employees and employers alike. If you would like to join or require further information, visit chamberpension.ky. And for information as it happens, follow us on Facebook, LinkedIn, or Instagram. Email admin@pensions.ky or call 745-7630. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you.
Money Sense, bringing an informed financial perspective to the Cayman community.
Good morning and welcome to Money Sense, the show where we discuss, debate, and consider matters of financial interest in the Cayman Islands, brought to you by the CFA Society of the Cayman Islands. Your hosts today are myself, Amy Hubble, and Georgie Logston. Hey, Georgie, it's been a while.
It's been months.
I know. Time has moved really oddly this year.
I know. We're a few weeks from the end of it.
I know, and it sadly is actually our last show of 2020. So we thought we'd take kind of a trip down memory lane to see what has likely been the most unusual year of our lives, at least for me. And Georgie and I are both female on-island financial planners and CFA charter holders, so it should be noted that our experience this year has likely been different from many of our listeners, and we do want to be sensitive to that. Anyone on island who has lost their jobs or loved ones due to the pandemic and lockdown measures. And that being said, our discussion today is going to focus just around, for the majority, the performance of the global investment markets, not necessarily just what's been happening here in Cayman.
Agreed.
Right.
Yeah, because it's been a pretty unique experience for us here in Cayman.
And everyone's experience has been different. I know that. I mean, some people have thrived, some people have suffered.
Yeah.
And so there's both sides, and we're all kind of floundering in the middle. But I think that there's some sort of kind of mental hurdle. If we can just get to 2021, we can all kind of reset a little bit. You know what I mean?
I agree. I think everyone's really excited about Christmas this year. The
Exactly.
Christmas preparations definitely started earlier than normal.
I put up my Christmas tree a lot earlier than I would normally, early November, just because I wanted some of that cheer and the lights in the house.
Yeah.
Well, how did we get here? How did this year start?
Well, it started off brilliantly, right? I mean,
Right.
the market...
Last year we had a 20-year up run.
Yeah, and it continued in January and February, all the way through to what? February the 10th, I think, when the market pretty much went into free fall. And what's so extraordinary about this year is that the way the market fell, or the magnitude of the fall, was completely normal in February and March, right? A 34% fall. You know, that happens, roughly once every
decade or so?
Yeah, a couple of times a decade, probably, that kind of fall.
Yeah, not to take light of it, but yes, that's something that we do kind of expect is going to happen from time to time.
Exactly. If you own global companies, you expect that every 4 to 5 years, they're going to be cut roughly by a third. Yeah. And that's exactly what happened, but it happened so fast.
Very fast.
We've never seen it happen that quickly before. I mean, it was 23 trading days that it took for the market to fall 34%. And that was the S&P 500, which actually did better than a lot of global markets, right? Because we were talking about the tech stocks earlier. The S&P 500 was helped by the presence of these big technology stocks that actually fared pretty well during that sort of February, March period. So we had this mad fall where we thought the world was going to end, you know, and that's how it is in every crisis. You look back over every crisis that we've lived through, and when you're deep in it, in that 30, 40, 50% fall, it feels like the world's going to end. You know,
Absolutely.
Look back to the financial crisis, the dot-com bubble, all of these things.
Because you don't know where the bottom is, and even in your mind. And you and I have been doing this long enough to have lived through at least a couple crises. I remember I walked to the gym and they were like, "How was work today?" I'm like, "Well, I lost more money than I have any day ever in my entire career."
Yes.
But
I mean, that's hard.
But we at least knew at the end of the day
that it was going to end.
That there was a bottom to this well, that we were falling down. But a lot of people, if they had not had any experience with this, turns on the TV every single day and nothing but just red. And this is not just made up money. This is people's retirement funds. These were people's money that they'd been saving for years and years and years, and had been coming off of several years of where stocks only go up, right? And stocks go up most of the time. That's not to say that they don't. They go up a majority of the time. So to say
punctuated by these wild rides.
But you have to be ready when sometimes these wild rides kind of happen.
Yeah, and you never know when they're going to happen. That's the thing. We want so badly to be able to say, this is when it's going to happen. This is the top. This is the bottom. And nobody knows. Nobody knew in February that was the top. And nobody knew on March the 23rd that it was the bottom. The old saying is that nobody rings a bell. There's no bell that rings to tell you that that's the bottom of the market. Yeah, it just turns.
I remember that night that Tom Hanks announced that he had the
Was that the
COVID.
Bottom? That was literally the bottom.
It was the bottom.
Yeah.
And there was the same night that they canceled the NBA, and our airport obviously closed on March 22nd. I remember that, and that was the dark days.
The world was falling apart.
But that was literally the bottom.
Right. And what's happened
we were
since...
just starting with the coronavirus.
And that's it. And you look back to the financial crisis, and it was the same. The bottom happens way before the bottom in the economy or the bottom in whatever it is that's going on, because the market anticipates the future.
Exactly.
So before things start to get better, the market has already turned. And I think that's what makes investing so hard, is that people always want to start to see things improve in the world before they feel comfortable getting in to the market. But that's too late, because the market's already turned. I mean, we've had a 70% rally from the bottom, 70%. And the vaccine came out, 2 weeks ago? 3 weeks ago?
Yeah.
And the market was at an all-time high. So if you've sat on the sidelines with cash, waiting for the vaccine to invest, you have missed.
Yeah,
This
even just
rally.
since November, you've missed 15%.
Yeah.
At least 15% in the U.S. markets, at least.
Yeah. So what do we take from this year?
Well, is it too late? Is it too late to invest, or should we
never too
should we
late.
just step away and be like, I missed it, never mind, I'll come back, and the next time it goes down? Is that what we should do?
No, we know that's not what we should do. Today is always a good day to invest, because, like you say, 75% of the time the markets go up. And I say to people every single day, the day to get your money into the markets, your excess money, right, over and above your emergency cash reserves and all the other things that we want to do as part of a sound financial plan, the excess money that you have, when you have it available, you have to put it into the markets, because if you don't, you're betting against the odds. And the odds are, like I just said, 75% of the time the markets go up.
Absolutely.
And I don't want to bet against that.
I always say it's like doing the two-step. If you've ever been in country line dancing, is you're just always taking 2 steps forward and maybe one that'll shuffle back. 2 steps forward and one shuffle back.
That's a good way to describe it.
But it's the best day to invest was yesterday, and the second best day is today.
That's brilliant.
Especially if you have a long time horizon. Even this 15% run up for a month, it will just be a blip in the past.
Yeah. There's a good saying, and I forget who said it, but if you think the market's high today, wait till you see it in 20 years.
No kidding. Yeah, absolutely. Which leads into just kind of what is driving the rally. I mean, obviously we hit the bottom in March, which just sounds so long ago from the perspective. This was before we even went into lockdown. I mean, it was basically the start of our lockdown.
Yeah. The market bottomed at the start of our lockdown.
And that was the bottom.
Yeah.
And so you think about the economy versus the stock market and how they work together. And you mentioned this, is that the stock market is projecting that things will get better. And when you think about it, that was the darkest day in terms of we didn't know what this virus was doing. We didn't know how to control it. We didn't even know how it was spread. We didn't know if we could get it again. We did not know anything about it. It was all fear. So everything dropped across the board, no matter who you were, no matter what stock you owned, everything fell down.
And not just stocks, bonds.
Bonds too, which was very unusual because usually in very volatile times, people will sell out of risky things like stocks and they'll buy safe things like bonds. Not in this case. They came out of stocks and they came out of bonds. They went to cash and Bitcoin. And
but even Bitcoin didn't have a great time in February and March.
It's kind of gone with the markets too.
Yeah.
But it was everyone for themselves, hide, buy food, hoard water, hoard toilet paper, and that's all people were buying. And I think that the market and the economy, because the market is so forward-looking, the economy is much more backward-looking. And I think that I like to think of them as kind of like pen pals that write back and forth. They're different people presenting at different times, but they're informing each other back and forth. So you've got the economy, obviously, that has record unemployment across all markets around the globe, whether or not be here, the United States, Europe, Australia, everywhere unemployment is high. That's not good, because when unemployment is high, people are not being paid, incomes are lower, and when incomes are lower, they can't purchase from the companies that we're buying stocks in. Stocks, on the other hand, have no choice but to be optimists. They see the future, they see what things can do. And that's why we see especially stocks that have flourished in coronavirus time, the pandemic time. I don't know what will ultimately come back to say this. What do you think the name of this time will be?
I have
Just
no
the
idea.
pandemic, COVID.
Yeah.
Have you seen those coffee mugs that are like earnings before interest tax?
Yeah, and coronavirus. Yeah.
It's like EBITDA and coronavirus.
Yeah.
It's exactly right. Every chart that we look at for the rest of our lives will have this like odd spike up or down in this one little area. But it's also a weird time in terms of, and we mentioned this earlier over breakfast, is that history will not remember how terrible a 35% drop was, only because of when it happened. And what I mean by that is if the year would have ended March 20th, we would have looked back and we said 2020, we lost 35%. And that would have been added into all the averages, onto all of the what's the worst year in history. I mean, you even look at like 2008. You look at 2008, numbers were terrible, it was probably down 25% for 2008. 2009, also down the first quarter, but there was again this exact rally, almost very indicative of the same year that you look at it at the return in 2009. Positive, very positive, double-digit returns at least. And so I do think that while there will always be this spike in economic data, when it comes to the market, it will be lost. It's lost in the in the volatility there.
Because the market, if the year ends today, the S&P 500 is up 15-16%, something like that on the year, which is the craziest
It's
thought.
insane.
I mean, when you go back to March, if someone had said to you in the middle of March, this is going to be a positive year, you would have loved that person out of the room.
Never.
And here we are, the 70% rally, we're 15% up on the year. 2020, as you say, is just, it's very similar to 1987, actually, which was the year of the of Black Monday, when the stock market fell 22.6% on one day. It was the biggest one-day fall in history. And around that 22.6%, I think the market fell 32 or something. So a similar kind of fall. But 1987 was also a positive year. Not possibly as positive as 2020 will be, but very similar in that very sharp fall, quick recovery, ending in a positive year. And I always pre-2020, I talked about 1987, and I always said to people, look, if you had fallen asleep at the end of 1986 and woken up again at the end of 1987 and looked at your account statement, you'd have said, okay, well, it wasn't an amazing year, but I made a little bit of money in 1987. Yet that year was the year that we had the biggest one-day fall in the history of markets ever. 22.6% on one day.
That's amazing. I mean, it really is amazing. Like the idea that you could have gone to sleep even in 1987 or this year.
Right. Fallen asleep at the end of 2019, looked at your statement at the end of 2020, you've said, 2020 was a great year. Yeah. But look what happened in it.
People always ask me how often they should look at their statements, and I always encourage them, obviously, to look at their statements, because you never, as an investment advisor, know what to advise people to look at their statements. But in terms of really concerning yourself with what you're investing in, I think the old adage is, every time you change your air filter, then that should be kind of when you do it. But we do need to take a quick break for our advertisement, but we will be back with myself, Amy Hubble, and Georgie Loxton after a short break.
The Cayman Islands Chamber of Commerce Pension Plan. We're here for you. Are you currently a member and interested in the management of your pension plan? If so, consider becoming a volunteer trustee. Becoming a trustee is a great way to play an integral role in the governance of your pension plan. If you'd like to learn more, email pensions@chamberpension.ky or call 745-7630. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you.
This is
Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands.
And now, more Money Sense.
All right, and welcome back to Money Sense with Amy Hubble and Georgie Loxton. We are talking about 2020 and the markets and financial implications that come along with it. In the first half of our show, we really kind of looked back in terms of what happened in 2020. A wonderful, just hip-hop scotch down memory lane. But let's talk about now and what people can do now, what they should be doing now, whether or not they have some extra cash because they didn't travel this year. Maybe they have some extra cash from taking out their pension, other things. I mean, it's like we said, the pandemic did not affect everyone the same. And so while some ends of the economy were hit so hard with unemployment, some ends of the economy were able to thrive and save some money. So what should people be doing right now?
Well, I think one of the big lessons from this year is that the world is really surprising. Right? It's the lesson to take from 2020 that you just never know what's going to happen next. And there's a really big financial planning implication to that. Mm-hmm. And that really is that from a personal finance point of view, you have to be able to protect yourself from the unknown. And as you say, many people in Cayman have thrived this year, but it could have been very different. Mm-hmm. And we don't know what's going to happen next. You know, the biggest events of any decade are the things that no one's talking about until they happen. And coronavirus was one of those. No one was talking about coronavirus in 2019. No one was talking about the Twin Towers until the moment that happened. No one was talking about, you know, the assassination of JFK until that happened. The big events are just the things that we have that it's the tail risk, mm-hmm. right? We don't know that these things are going to happen. And if you apply that to your life, you say, we have to be able to ride out those things. And cash is one of those ways, right? By having a cash buffer to protect you from those unknowns, mm-hmm. I think is so important. But at the same time, you don't want to have too much cash.
Right. Absolutely.
You know, because cash, as we know, sits in the bank and it takes you backwards quite quickly because it erodes your purchasing power because the cost of living goes up and cash doesn't go up in the same way that the cost of living goes up. So you have to do something with your money in order to maintain your purchasing power. But at the same time, I do think that 2020 is a year where people can say, I really just want to keep a little bit extra cash. And I think that generally is really not a bad thing at all.
Yeah. Oh, no, absolutely. And I actually hear a lot of the differences. I hear a lot of people that I think don't have kind of their financial life in order now trying to invest. And what I'm really hearing is that they're wanting to gamble on a quick bet. And a lot of times I like to think about when it's appropriate for you to invest is like building a pyramid. You can't build a pyramid from the top down. Mm-hmm. You can only build a pyramid from the bottom up. And your bottom layer is that cash buffer. It's that making sure that you have enough money if an emergency happens, if your air conditioning breaks, if you need new tires, all these things that you need to make sure that you have access to. And that's going to be a little bit different from everybody, especially in years like this when there is some uncertainty. And if there's moments that you need to keep just a little bit of higher cash just for you to feel good and feel safe, that's okay. Yeah. I think Georgie and I would both 100% say it is okay to keep more cash than financially feasible if it makes you more comfortable.
Yeah, if you sleep at night.
Absolutely. Yep. Sleeping at night when it comes to your finances is absolutely the most important. And once you have that built, then you need to start for your long-term investing in retirement. And that means diversified long-term portfolios, index funds, things like that. Then, after all these things are in place, that's when you can kind of start to invest in some of those funner things. Is funner a word? I don't know. Fun, more speculative things that you may just want to be taking bets in. And that's what I hear a lot of people coming to me is about what one stock should I buy? And that's never necessarily that where they are in the pyramid needs to base.
Absolutely. You've got to have that core, as you say, mm-hmm. of diversified global, hopefully companies, and maybe there's some bonds in there. I mean, we can talk about whether anyone ought to own bonds in this environment, but global stocks, hopefully, is going to make up the majority of it, assuming you've got a good cash buffer.
Mm-hmm. And a long time horizon.
Yeah, and then, as you say, if that's your core, then sure, you can have some fun with some cash around the edge where you want to, I don't know, buy whatever those hot stocks are. But know that that's not the main body of your portfolio. It's not where you start. Totally, Amy. It's not where you start. And you're right that so many people, I think particularly those maybe in their 20s, think that is where you start, like with these 5 hot stocks. But that's a really dangerous path.
Yeah, and I see that 100%. And I have mixed feelings about it because the idea that you can trade for free has opened up so much more access to people being able to invest, which I think is absolutely wonderful. I 100% believe in tearing down barriers to have anyone in the world having access to investing. And this time in history is the first that has ever occurred. 50 years ago, if you wanted to buy a stock, you had to go down to the stock exchange, phone up your broker on your home phone, or send a fax, and then your broker had to go down to the literal stock market and do their hand signals and buy and sell what you want to do. And then you're going to get charged, it was like 7% commission exactly on every single purchase, buys and sells. That does not happen anymore. Today, you can go on Interactive Brokers, you can open an account in a day, and you can trade for nothing anytime you want. And down here, capital gains, tax-free. Yep. So it's tempting.
Yeah.
I get it.
And it's sort of turned, I think, investing into entertainment in many ways.
Exactly.
I mean, Interactive Brokers maybe not so much, but the apps like Robinhood, which are big in the US, I'm sure some listeners have heard of them, they gamified investing. They've made it like entertainment, and good investing really should not be entertaining.
Exactly.
Listen to Warren Buffett and all these titans of the investment industry. Good investing is boring. It shouldn't be exciting,
exactly
right? I mean, it's like there's a good saying around the pilot. It's like a pilot says that flying is all about 90% boredom punctuated by moments of sheer terror. And investing's a bit like that, right? We had the moment of sheer terror in February and March of this year, but most of it should be pretty dull. I mean, you shouldn't really be getting excited about your investment portfolio. If you are, you're probably not globally diversified, and you're probably in all the hot stocks.
I know. All those people in their 20s are listening. Actually, they're probably not out of bed yet, but if they're listening, they're like, those old stodgy women are telling us that we're not making money. And it's been a wild year. And if you would have invested at the end of March and you bought these coronavirus stocks, and we'll talk a little bit about it, is you've made a lot of money.
You've done really well.
You've been up at least 70%. Maybe you might have doubled your money, and in your mind you're like, I'm good at this.
Yeah. This is easy.
This is easy. Why wasn't I doing this before? I'm going to quit your job. But the other question is, the other side of the coin is, are we in a bubble? I mean, that's the question that I get asked so much. And I think anytime you see a very quick run up from this vaccine news is those speculations of always bubble talk. Mm-hmm. Are we in a bubble? Mm-hmm. Are we in a bubble? Mm-hmm. And my answer would be no. And these are the reasons that I wrote down, that I thought that we're not necessarily in a bubble when we look at the stock market or the global market in general. One is what we just talked about. There's more access to people being able to put money into the markets very quickly and very cheaply. So there's more money coming in. Two, interest rates. The 10-year U.S. Treasury, which is kind of the benchmark for risk-free investing, is yielding less than 1%. Mm-hmm. And honestly, it's the highest it's been in 9%. I mean, over the summer, I think it was down to like 50 basis points or 65 basis points.
And let's just put that into context, because that's the nominal return.
Yes, exactly.
And what you have to look at when you invest is your real return. And that is the return you're going to get after inflation. We mentioned inflation because inflation eats away at your money.
And taxes. A U.S. Treasury, you have to pay U.S. taxes on too, whether or not you're here, whether or not you're a U.S. citizen. That's a fully taxable payment too. And that, to put it in perspective, the U.S. 10-year Treasury means that you loan the U.S. government $100 for 10 years, and in return, they pay you 95 cents a year. And then after 10 years, they pay you that $100 back. Now, there's a lot of inflation that happens in 10 years. There's a lot of taxes that get in your way. That's not worth it. But people are still buying it because there's nowhere else to go in a risk-free environment. And that's where we talk about the U.S. debt getting very, very high. Every auction of U.S. Treasuries are oversubscribed. It's very, very odd, but consider that the U.S. government can borrow that cheaply. But on the other side, people aren't thinking that that's worth it. They have to go somewhere. That money has to go somewhere. This money isn't, the money that's in the market isn't artificial. That money is real. That money has been created because a lot of liquidity has been pumped into the market. The problem is there's not as much earnings to go around. Now that's okay, especially in times of very low interest rates. We can all kind of share in earnings just because we have no other place to go but companies that pay dividends, companies that are growing. And then you also have populations that have some extra cash on the lines. Again, it's not been equally diversified in terms of how everyone's been affected in the coronavirus, especially when it comes to finances. So I don't think necessarily the markets are in a bubble. A 15% stock market year is not something to go shout from the streets are. This is a relatively normal year. The U.S. stock market, on average, since 1928, I think has returned 11% on average per year annualized. So that's not that big a deal. But what does concern me is when I look out there and I see these hot pandemic stocks. And I'll give you a couple examples. And disclaimer, I am also a registered investment advisor in the United States, and this is not stock advice, but this is maybe some education on how to kind of evaluate some stocks. So let's think about DoorDash. So DoorDash is a meal delivery service, kind of like Bento or Let's Eat in the US. And it just IPO'd on the market yesterday. And after one day, it jumped 800% to a market cap of $60.2 billion. And to put that in perspective, that company, which is just an app and some delivery drivers, is worth more than Chipotle, Domino's, Shake Shack, and Papa John's combined.
And does it have any earnings?
Not yet. No, it's got like negative $413 million in earnings. And it's not alone. You think about Zoom, and obviously we're all using Zoom. So this is one of those stocks that people have had so much experience with, and they're like, okay, we're all using this, we're going to buy it. But Zoom, so remember I just said DoorDash had a market cap of 60.2. Zoom, something that is very replaceable, Microsoft Teams, Slack, a mere Apple FaceTime, things that are very, very easily replaceable. Zoom has a market cap of $117 billion, and it's up 500% this year. That's larger than the combined market cap of the entire airline industry. Delta Airlines, America Airlines, United Airlines, Southwest Airlines, all combined. Zoom, a computer app, is bigger than the airline industry and all those planes.
And I think a really good point here to make is that there's a really big difference between a good company and a good stock.
Yes.
And you can look at these big tech companies and say they're great companies, right? They have great technology. But a good stock or a good investment is all about the price at which you buy that company. And when you're buying these sorts of companies on those kinds of valuations, it probably is not going to end up being a good long-term investment.
Exactly. And that's where you get in these quick run-ups, is it is really hard to distinguish the good companies from the bad companies because everything is going up. Same on the downward too. But it is important that you don't just get caught up in some of these. We are getting close on time, but I just wanted to point out a couple other Peloton, which we've heard on the bicycle app. Last Christmas they were getting all this flack for that commercial where the girl got the Peloton for Christmas. Peloton's price to earnings ratio is 986 times, which means that you have to invest $986 for $1 in company earnings. But they are actually profitable, Which is
so that's
amazing.
something.
Especially after all the flack they took last year.
Yeah.
So it's just been a crazy year. But unfortunately, we are out of time, and things go very, very quickly on this show. We have a very short show. But we want to wish everyone in the Cayman Islands and around the world listening to have a very happy holiday season, regardless of the holiday that you celebrate. And as a final note, we wish to remind our listeners that a rebroadcast of today's show can be heard as a podcast on the CFA Society Cayman Islands webpage, and as well as all of your favorite mobile podcasting platforms. We encourage anyone who has a question or topic and wishes to cover, please tweet us at Money Sense Radio and join the conversation. With that, this is our last show of the year, so we will be back in January. Happy holidays.
Money Sense is brought to you by the Chamber Pension Plan. For further information, visit chamberpension.ky.
The Cayman Islands Chamber of Commerce Pension Plan. We're here for you. Are you aware of the performance of your pension plan? The Chamber of Commerce Pension Plan provides quarterly fund fact sheets for our members to stay informed with the plan's performance. For the year ended August 31st, various life cycle funds provided returns between 9.2% and 16.5%, and our all-in expense ratio is currently the lowest it's ever been, a record low at 0.72%. Visit chamberpension.ky to review our fund fact sheets. You can see the performance as far back as 10 years. Remember that pensions are a longer-term investment strategy. Focus on the long term rather than the short-term returns. The Cayman Islands Chamber of Commerce Pension Plan continues to perform for you.